Hey everyone, welcome back to the channel. If you've been hunting for the perfect dividend ETF in 2025, chances are you've come across two heavyweights, SCHD and DIVO. Both promise steady income and long-term growth, but they go about it in very different ways. So today, we're breaking it all down: performance, strategy, yield, and which ETF truly reigns supreme this year. By the end of this video, you'll know exactly which one fits your investing style, or whether combining both might actually be the smartest move. Let's dive in. Hello viewers, if you are enjoying this content, and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us, and remember to comment and share. First up, we have SCHD, the Schwab US Dividend Equity ETF. It's one of the most popular dividend ETFs in America, and for good reason. SCHD follows the Dow Jones US Dividend 100 Index, focusing on companies with a solid history of paying and growing dividends. Think of SCHD as the disciplined investor, low cost, consistent, and built to last. It screens for strong fundamentals like cash flow, return on equity, and dividend sustainability. And here's a big plus: the expense ratio is just 0.06%, meaning more of your money stays invested and compounding. As of 2025, SCHD's dividend yield hovers around 3.8%, paid quarterly, and it's increased dividends almost every year since launch. That's long-term income consistency investors love. Now on the other side, we've got DIVO, the Amplify CWP Enhanced Dividend Income ETF. Unlike SCHD, DIVO is actively managed and uses a covered call strategy. That means in addition to collecting dividends from its 20 to 25 high-quality blue-chip stocks, it also sells covered call options to earn extra income. The result? A higher yield, roughly 4.5 to 5%, and it pays monthly. DIVO's top holdings often include big names like Microsoft, Apple, Visa, and JP Morgan, the kind of companies you'd want to own anyway, but with an income twist. Now, active management and options mean a higher expense ratio, about 0.55%, but investors often find it worth it for the smoother cash flow. So already, we see the contrast: SCHD focuses on dividend growth and quality, while DIVO focuses on consistent income with a defensive tilt. Let's talk results. Over the past few years, SCHD has built a reputation as a steady performer. From 2013 to 2023, it consistently outpaced many dividend peers, thanks to its exposure to top-quality companies like Pepsi, Texas Instruments, and Broadcom. But 2024 and 2025 have been more challenging. After recent rebalancing, SCHD's portfolio became heavier in energy and financials, sectors that can swing more wildly. Meanwhile, DIVO has quietly impressed. Its option premiums helped cushion returns during volatile markets, and its monthly dividends have been a big draw for income investors. In 2024, for example, DIVO outperformed SCHD in total return, largely because of its defensive covered call strategy. So, which pays more? DIVO wins on yield, no question, monthly income around 4.5% versus SCHD's quarterly 3.8%. But SCHD usually wins on dividend growth. Its payouts have grown faster over time. If you reinvest dividends and hold for the long term, SCHD's compounding advantage could outweigh DIVO's higher upfront income. Costs and taxes matter more than most investors realize. SCHD's ultra-low expense ratio of 0.06% means minimal drag on returns. DIVO's 0.55% fee is higher but pays for active management, and the core writing strategy. In a tax-sheltered account like an IRA or TFSA, that difference might not bother you. But in a taxable account, DIVO's option income can complicate things. Some distributions include return of capital, which can reduce cost basis. SCHD, on the other hand, pays mostly qualified dividends, which are typically taxed at lower rates. Then there's risk. DIVO's covered call strategy actually lowers volatility a bit. You give up some upside, but it cushions downside. SCHD takes on normal market risk, though its focus on quality companies helps limit big drawdowns. So, DIVO may be better suited for investors who crave steady income and lower volatility, while SCHD may fit growth-oriented dividend investors who reinvest and think long-term. Let's imagine 3 possible market conditions for 2025 and beyond. Scenario 1, bull market. If markets surge upward, SCHD takes the crown. Why? DIVO's covered calls limit its upside. It earns option income, but that income replaces potential stock gains. SCHD captures all the growth plus dividend increases. Scenario 2, sideways market. If stocks move sideways, DIVO shines. Covered calls thrive in choppy conditions because the ETF earns steady premiums even when prices don't move much. Investors love that consistency. Scenario 3, bear market. If markets pull back, both ETFs will drop, but DIVO's income from options helps soften the blow. SCHD's focus on high-quality stocks also helps, but it'll likely see sharper declines. So overall, bull market SCHD sideways or mild bear DIVO long-term compounding SCHD no clear knockout. It depends on the game you're playing. So, which dividend ETF reigns supreme in 2025? If you're building long-term wealth through reinvested dividends, SCHD remains one of the best options out there: low fees, consistent growth, and tax efficiency. But if your goal is steady monthly cash flow to supplement retirement or living expenses, DIVO takes the win. It's perfect for investors who value smoother income over maximum growth. And here's a little secret most investors miss: you don't actually have to choose one. A 70-30 split, 70% SCHD for growth, 30% DIVO for monthly income, gives you the best of both worlds. So there you have it. The battle between SCHD and DIVO isn't about who's objectively better, it's about what you need as an investor. If you found this breakdown helpful, don't forget to like, subscribe, and turn on notifications. I post deep dives like this every week to help you build smarter income portfolios. Drop a comment below: are you Team SCHD or Team DIVO? I'd love to hear your take. Thanks for watching, and as always, stay invested, stay disciplined, and I'll see you in the next one.